Hello, I'm Sam Stovall, U.S. Equity Strategist for S&P Capital IQ. In this week's Sector Watch, I discuss Q1 EPS estimates. In what could be taken as a delayed April Fool's joke, the Bureau of Labor Statistics reported that the March jobs count rose by only half of the expected amount. As a result, investors would not be faulted for shifting their worry from a Fed that is committed to tightening to an economy that is flirting with recession, corroborated by the cooling in EPS growth expectations. Capital IQ recently reported that Q1 2015 S&P 500 operating EPS likely fell 3%, which would be the first drop since Q3 of 2009. 5 of 10 S&P 500 sectors are projected to show EPS growth in Q1, led by consumer discretionary, financials, and healthcare, while the decliners were led by energy, materials, and utilities. To make matters worse, revenue growth in Q1 is expected to have slipped 1.2%. Even though Q1 EPS should decline 3%, history shows that actual results have been 2 to 4 percentage points higher than initial estimates. As a result, there is still a possibility that EPS will rise. This quarter's headwinds include foul weather, a West Coast shipping strike, a 20% rise in the value of the U.S. dollar, and Q1 GDP growth that is expected to be only 1%. The 50% year-over-year decline in the price of oil should serve as a bit of an offsetting tailwind, however. Yet if the recent jobs report is any indication of future economic growth, the answer to whether we will eventually slip into an economic recession is blowing in the wind. I'm Sam Stovall, and I'll talk with you again next week.